This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hello. We're going to take a look at impairments. You met impairments in financial reporting, but I would expect you to be a bit rusty on it, so I'll run right back through the rules. What we need to know is when you have to do an impairment review, and then how the accounting works for that. What's the difference between impairment and depreciation? You know, I had a friend years ago who always wanted to drive a bus and spent ages trying to get through the test and eventually passed the test. And then on the very first day, I can still remember, rang me in tears because unfortunately my friend on the very first day of driving her bus had driven it to a house in a place called Croydon. It's the south of London. And as a result of that, there was half a bus and half a house come to that. The people were very grumpy about it. But that's impairment. Impairment is all about some great big cataclysmic thing causing the value of the business to fall. I want to start actually partway in the section where it talks, first of all, about when you have to do an impairment review. That's down in section 2. It's needed in 3 scenarios. The first one is if there's an impairment indicator. An easy way, if you have an iPhone or something next to you, if you hit it with a hammer, that will be an impairment indicator. But we'll look at that list in a minute. The second and third points are important though. You have to do an impairment review again every year in some circumstances. First of all, if you've got goodwill. So in other words, if you're preparing group accounts, goodwill is not amortized in the group accounts, but you must check for impairment every year. In addition, you need to do the impairment every year. Again, if you've got an intangible where you're saying the life is indefinite. Maybe you've got a brand in your balance sheet like Coca-Cola where you can't really say you should amortize over 10 years. So you're not amortizing, but again you need the impairment review. Most commonly, of course, though, it's caused by an impairment indicator. There's a list of these up in the notes. I don't think you especially have to learn them because you're not going to be asked for a list, I'd have thought, at this level. And I think you just have to recognise them. But you can see the sorts of things. So significant change again in technology. Some massive external factor like a pandemic or something. Internally, it could be you've just damaged your assets. All sorts of things like that. Or you simply keep making losses. In any new business, you probably make losses in the first couple of years, but that's okay as long as they're in line with expectations. But if it becomes a habit, then probably you need an impairment review. In a people-based business as well, losing the key staff, like losing a key fund manager. So those are the sorts of things that would generate the need for the impairment review. What do you need to do? Well, the key rule, which I'm highlighting in blue, is that I need to compare the carrying amount of the asset or assets with its recoverable amount, how much money, again, you could generate from that asset. And of course, if the money you could generate is less, that's when you need to write the asset down. So assets sometimes have to be written down to recoverable amount. Recoverable amount is the greater of 2 numbers. One is the number if you sell now, and one is the number if you continue to use. When I'm teaching in the classroom, I have a theory that the asset in the classroom that is most used is the clock, because students seem to watch it second by second by second, tick tock, tick tock. So if the world government banned accountancy training and I was stuck with this clock, I could sell it now by going to a market or in a garage sale or car boot sale. That would be fair value less cost to sell, or I could find another use. In the West End of London, again, I could conceal the clock in my big overcoat, approach unsuspecting tourists and say, would you like to know the time? And if they say, yes, please, then produce this timepiece, the clock, and say it's 8 o'clock and charge them $4. That's my value in use. But either way, if you can actually sell it for more than you could get from using it, you'd sell it. If you were going to generate more by using it, then of course you'd continue to use it. The key thing is, of course, that this number, value in use, is where you're looking at the future cash flows, for example, over a period of 5 years. You're then discounting them to present value. What you should know is that when they do that discounts, the discount rate should represent the risk in the assets. When you studied financial management, you met betas, which was all to do with uncertainty and risk, and how some assets or companies, whatever, would have a big beta where their share price could go bong, 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 bong. Some assets, again, would not have such a big beta, less uncertainty, beep, 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 beep. So you need to take account of the risk in the asset. So I'm guessing that if it was something like a bank or something, then you'd have a fairly high discount rate. But different parts of the business may have different discount rates when we calculate value in use. Again, we don't need to get too stressed because obviously we wouldn't be entering a big discussion of them in this exam. You'd just be discounting at the rate that they gave you. So we need to look at the greater of the money generated if you sell it now and continuing to use it. That's what we use for recoverable amount. Now, when we do this, when we look at this again, what we will do in practice is normally divide the assets into cash generator units. Now, when my friend bashed the bus, I guess it was just one bus. It was an individual asset, in which case the loss on that just went to P&L, debit P&L, credit bus in the books of the company that owned the bus, or half a bus. In practice, though, the assets are usually grouped into lumps, or clumps, perhaps is a good word, which are known as cash generating units. So you need to learn the definition of cash generating units. They are the parts of the business that generate income independently from other segments. So I do some work with a very large training company that offers training in everything, no matter whether you want to be an accountant or a lawyer or a nurse or even a dentist, I think. Now, presumably, if you went through a course to be an accountant, you wouldn't finish it and then say, well, I think I'll be a dentist now. It's not what happens, is it? So as I've said in my example, a tuition company would regard accountancy and nursing training as separate cash generator units. So they split the assets up into those cash generator units. Why? It's because each of them would have different discount rates. So you're not going to have to get into the horrid maths. I'm sure some of you would like to, but you're not going to in this exam. But they'll have different discount rates to work out, again, the money that would be generated by each of these cash generating units. Sometimes it's quite difficult to divide assets into cash generating units. So things like goodwill and head office, well, perhaps they can't allocate them. They sometimes do this test in 2 stages where they look at the individual cash generating units and then look at the business as a whole. So it can be a very, very messy calculation. What you need to know, though, is that once you've decided how much the impairment is, in what order should the assets be written down? So this is the bit that needs learning here. First of all, if you do have a specific asset that's obviously impaired, so you're a bus operator and someone has just reversed your bus into a house in Croydon, that will have to go first. Secondly, if there's any goodwill in the cash generator unit, that goes second. And thirdly, the rest of the non-current or fixed assets. It's only the non-current or the fixed assets. Again, current assets are already at lower of cost and net realisable value, so it's just the non-current assets that will get written down. We'll look at some numbers for that in a moment. Before we do, then again, it's just the question, can you reverse the loss? Well, yeah, it happens sometimes. So the instance that I've given is something like a global pandemic, which would cause massive impairment losses, particularly in, say, hospitality. Once they've discovered a vaccine, again, that's successful, of course, the loss can be reversed. The only exception is goodwill. Goodwill you cannot actually write up again. I think there would be too much confusion about how much was purchased, how much was non-purchased goodwill. But if someone says to you can reverse impairment losses, yeah, it's fine. The double entry would work in the other direction. The big double entry, though, isn't it, is that what we are doing here is that we are debiting profit and loss and crediting one or groups of assets. What you could do, if you like, is pause the recording, have a read of Peter, and then I'll take you through the numbers in just a minute. So we're going to take a look at Peter, and we're trying to assess how the impairment loss in Sharon, a subsidiary, is going to be allocated amongst the assets. So I'll suggest a little pro forma for this because there's lots of things going on, isn't there? We could use a 3-column little working. So this is the example of impairment. I'm going to put a column for the existing carrying amount, which I'll call CA. A column for the impairment. And a column for the final figure, which is the recoverable amount. I'm just copying the figures from the question. So we've got some goodwill of 2,400. We've got a building, and the building is 6,000. We've got some plant and equipment with 5,200. We have, what else have we got? Oh, intangibles. The intangibles have got a carrying amount of 2,000. And finally, we've got some current assets. Remember, those current assets are never impaired. And the value of the current assets is 1,400. So that's 8, 4, 13, 6, 15, 6, 17. Yep, 17,000. Unfortunately, there's been a bit of a disaster. And so the first thing I'm filling in is, unfortunately, let me highlight the numbers in blue as we found them. We've got the 17 already. The recoverable amount. There's been a fire. There it is. The recoverable amount of the whole business is now 9.8 million. So the figure over here on the right is 9,800. I filled that in first. Now I know the total impairment, which will be the balancing figure. So 17,000 minus 9,800 would be 7,200. That's my balancing figure. And then remember the pecking order as to who gets written down first. The first thing that gets written down is assets that are obviously impaired, particularly the building, which has been, is it the building? No, it's the plant. Let's just see. What's been obviously, on the plant side, I'll highlight this in yellow. 1,200 has been destroyed and the rest was worth its carrying value. So I'm dealing with the plant first. I know that the write down on plant is 1,200. There's no point in writing stuff down below the value at which you could sell it anyway. So I'm going to take 1,200 off the value of the plant. Let me number that as number 1. So the revised carrying amount of the plant is therefore going to be 4,000. Secondly, I'm going to go for the goodwill. The goodwill has a carrying amount of 2,400. That's all going. Can you see we still haven't got up to 7,200? So we're left with a building and the intangibles. Nothing's going to come off the current asset. So I might just carry that across. So if you were told nothing else, you'd prorata the loss between the building and the intangibles. But if you get any clues in the question, use them. Let me change colour highlighter to green. I know that the patent is worth 1,500. So I think what I will just do straight away is write down intangibles by 500. That's 1,500. And then the rest, again, I'm just going, well, all we've got left is the building. So what's left? 7,200 minus 500 minus 1,200 minus 2,400. I think that's a loss of 3,100. I'll take off the building. So I think the recoverable amount of the building would be 2,900. Just do a quick check in the right-hand column. 2,900 plus 4,000 plus 1,500 plus 1,400. That's 6,984. Yes, that's 9,800. That's fine. So when you look back through that, the first thing that we did was to identify the 9,800 and the 7,200. And after that, we started to decide how the impairment would be allocated around the assets. As with many things, you'll have met it in financial reporting before, but it's always good to look at these things again because they sometimes get a little bit rusty. But there is your core knowledge again in terms of impairment of assets, particularly impairment of cash generating units.